Okay, great. Let's get started. Good day, everybody. My name is Emmett Kilduff, the CEO of the Fortia Group. Welcome to today's webinar, the Q3 2024 quarterly webinar regarding the valuations of e-commerce brands. As always, I'll just briefly give you an update on progress and items at the Fortia Group. We'll then walk through the Q3 2024 report, and we will leave time for Q&A at the end. To submit your questions, please do so via the Q&A tab on Zoom. Please don't do it via the chat tab. It's much easier for us to coordinate that. And if you submit them early, it means our participants, our panelists can answer them as we go. Recordings of all the Fortia Group webinars are available on our YouTube channel. So please subscribe to that so that you can get the latest updates as they come live. Okay, so on our side here at the Fortia Group, just wanted to make sure that the positioning of our firm is clear. We've had a few small changes over the last quarter. So we've decided to focus in on M&A within the investment banking services. So typically investment banking firms offer M&A, equity raising, credit raising. We as a firm have decided to narrow in our focus just to be pure M&A advisors. As hopefully most of you know, our focus is the lower middle market, which is typically working with companies doing 10 million revenue up to 200 million revenue. When you go above that, some of my former colleagues start to be hard to compete with, frankly, with a small firm such as ourselves. We do work with companies that are slightly below 10 million, particularly if they're looking to exit not now, but in 25, 26, and we can help groom them or help them become exit ready. The other slight change is that we've expanded or broadened our sector coverage. So as you all know, the reason you're here today is all about e-commerce. We started life as a pure e-commerce investment bank. Last month, we broadened that out to cover four other sectors, which are AI and data, three other sectors, excuse me, AI and data, health tech, and SaaS. We've chosen those sectors. They're obviously interesting sectors, but also because we have genuine operational expertise in those. I founded an AI and data business called Eagle Alpha 12 years ago when I left Morgan Stanley. I just incubated a health tech business called Pitstop, which is the first personal growth app for men. And David, my co-founder, he was CFO of a SaaS business. So we genuinely understand those areas and look forward to working with companies across those sectors. I wanted to give everyone on the call a heads up, both acquirers and brands, about our Acquirer Summit. 9 months ago in January, we hosted a one-day conference in New York for acquirers. And next January, in a few months' time, we will be hosting a week-long summit for acquirers. So we welcome aggregators, strategics, private equity firms, family offices to reach out to learn more about that. But we also welcome corporates. The whole idea is to invite a select small number of corporates to showcase their business to the acquirers. They don't have to be for sale at the time. They could be just soliciting early feedback and being groomed for a sale in later 2025, 2026. So if you know of any e-commerce businesses that want to gear up for a sale, there isn't another conference like this where you get that many acquirers in one room. And if you have anyone in your Rolodex who are in those other sectors that might want to showcase their business, please do reach out to anyone at the Fortia Group. Okay, so let's get into the report. We have our biggest speaker lineup to date on all of these webinars that we've done. John is the first to speak. John has spoken on many webinars, has super data-driven insights from Grips. Austin has looks like some great news to tell about the valuations of listed e-commerce businesses. Ken, who we've known for many years from his days at Thrasio, will give us insight into how a D2C aggregator like OpenStore works and some of the deals they've done. My colleague Paul will talk about some of the brand metrics and things operationally that brands can do to improve their chance of an exit and valuations on exit. And then we'll finish with Stephanie, who we've known for a long time. Stephanie is an investor advisor, board member, and e-commerce expert. As ever, we structure the flow of our report and our webinar into six ingredients that ultimately yield to where we think the valuation ranges are today. 4 of those are outside of the control of the entrepreneur, and 2 are within the control of the entrepreneur. So I'll talk about global M&A activity. John will talk about e-commerce trends. Austin will cover public market comps, and so on. And we'll ultimately get to the most important bit, which is where are valuations today. And thankfully, to give a little bit of heads up, we have we're feeling in a better place than we were on our previous quarterly webinars. There's light at the end of the tunnel. So starting off with section 1, global M&A activity. It's all about activity on the Fed. But even before we had the Fed reduction last month, I think it's important to note that we were seeing green shoots in terms of M&A deal count and deal value. So if you look at the data here, which was from January to August 2024, you were seeing some big increases in deal count, particularly of large deals over $1 billion plus, but also of smaller deals, 100 million to $1 billion. I appreciate that's a lot bigger for a lot of people on the call, but it's still a good barometer as to where things are going. And on the deal value side of things, which is as interesting, if not more interesting, there's plus scores all the way down on these rows. So we're seeing better deal values, higher deal values go through. So this is even before the Fed cut. If we look back then and think about prior Fed cuts, what typically happens? So let's go back to Q3 29 and Q3 2020, which were sort of the last time there was significant rate cuts and GDP growth following those rate cuts. Typically, what you saw after a year was that the M&A deal count increased by 25%. And we think, the Fortia Group, we think that'll be higher over the next 12 months for a variety of reasons, which I'll jump into now. They are primarily 5 reasons. The first is if you think back to those other 2 periods of time, is the global financial crisis and COVID, much more sort of serious episodes in our economic history than where we are today. And some of the dynamics in terms of credit were extreme. We don't have that today. GDP is already in a pretty good spot compared to those other time periods. So we don't think we'll have to wait as long as we did post the previous 2 rate cuts in those periods of time. The third reason is, the equity markets have been performing relatively well, unlike the 2 previous periods of time again. PE are in a better position. There's a lot of dry powder, which we've talked about on prior webinars. They're clearly beginning to put it to work based on the stats 2 slides prior. And, we hope that will continue. And, hopefully when we get to the other side of the election and there's less uncertainty about the economic environment, then we'll start to see a significant ramp up into year end and through 2025. So we've been waiting for this rate cut for a while. At the start of the year, we thought it would be much sooner. Thankfully, it's happened, and we hope more cuts will come in Q4 in the fall, and that'll put us in a better position in 2025. Okay, so that's the M&A scenario. Let's then jump into e-commerce trends, and I will hand over to John. You there, John?
Yeah, I'm here. Thanks, Emmett. Great. So just to give you a quick overview of what GRIPS is before we dive in, GRIPS measures e-commerce activity. We are almost exclusively focused on e-commerce, looking at the e-commerce transactions, revenue, average order values, and growth rates of over 60,000 e-commerce domains globally. And that includes both e-commerce retailers as well as D2C brands. We also are now increasingly reporting that level of data all the way down to the SKU level. So we really have a great idea of understanding of what's happening globally in the e-commerce landscape, which makes us, a really reliable expert in which to give a forecast on what is happening in the e-commerce industry overall. And, this is not my first time, as Emmett mentioned, presenting on one of these webinars. And so you've joined before, you'll know that Grips produces this quarterly estimate of what's happened in the previous quarter, and we're about to also release kind of our overall e-commerce forecast for Q3, and we're going to be doing that next week. And our estimates really trend very closely with the U.S. Census estimates. So if you're interested in that and understanding what that is when we release it next week, please reach out either through Emmett or LinkedIn or whatever. But we'll jump in and look at kind of how the e-commerce industry is performing in the United States by the individual sectors. Kind of, and it's like kind of be the next slide if you mind. There we go, perfect. So we break it down into kind of major domain categories. So, instance, you're looking at like electronics and jewelry. These are the more vertical oriented domains. And then you have like this big mass e-commerce marketplace typical, which is like the Amazons and the eBays and whatnot. So we're able to see kind of quarter over quarter, year over year trend in the space. And we've been tracking this obviously for multiple years and presenting it to the Fortia group attendees. And this quarter, is no different. We're going to look at what grew in the last quarter and what kind of showed a little bit of softness. And I will say that, first of all, when we were starting to look at this, in the last week or a month, we were looking primarily at early indicators for the months of July and August. And then we added on September as soon as we had that data. And I will say that, we're seeing this with Alphabet's forecast, which Grips produces as well. But we saw a little bit softer data in the month of July and August, but September came in really strong and helped give us an overall strong quarter. You can see that in the categories that are growing. There's more and bigger categories on the right side of the quadrant that you see here. Electronics being the one that grew at the fastest rate. We're going to dig into a few of these categories, including electronics. Electronics was largely driven by Apple, but we're going to dig into a few of the other trends that are driving electronics growth. Jewelry is another interesting one that's showing really strong growth, driven a little bit by watches. It also includes some luxury brands. Interestingly, when we look at the beauty category, if you've joined these previous webinars, you may have seen that beauty was sometimes in the negative territory, but it is ever so gently moved into positive growth in the last quarter. And we're going to dig into some of the trends that are driving beauty's growth currently. Apparel and sports is also has been a regularly strong contender over the last few quarters, and we're going to continue to see growth there. Some of the changes that we noticed this last quarter is that pets and grocery, which had been really strong growth categories over multiple years, driven by kind of COVID spending and COVID shifts, but they have moved gently into the negative territory in Q3, maybe suggesting that we've kind of reached a plateau, at least for the time being. They're not showing significant losses, but the growth has definitely moved back into a little bit of negative territory. And then home and garden, even though those rate cuts came in September, they weren't quite enough or long enough in the quarter to affect the overall movement for the home and garden category overall. But we are seeing some really positive growth in certain sectors in home and garden, and we're going to dig into that. Health really was driven by CVS and Walgreens problems that they're having, and vehicles are the other two kind of like lowest performing categories, posting kind of a continued growth quarter over quarter and year over year. And so I'm going to dig into kind of the next category. We're going to dig into some of the industries that we're looking at, starting with beauty, because that one, again, I mentioned was in negative territory before, but it moved into positive territory in Q3. So as we kind of dig in, we can see that it grew just 6.6% year over year in the quarter. With those top sites, we're looking at the top 500 sites in the United States, generating just shy of $1.8 billion in sales. And that includes a good mix of, retail beauty and cosmetic sites, but as well as a lot of D2C sites. As you can see here, you look at the key metrics, you see sessions are down, conversion rates are down, but average order value is up. It's one of the only things that's really kind of pushing beauty over into the positive territory. So, if interest rates kind of come back into line and come down, we may not see that average order value being able to pull the entire category in the future. So we'll keep a close eye on that and make sure that that's not really just driven by interest rates or inflation, but really driven by the fact that consumers want to spend more. So we're going to keep a close eye there. If we dig into the next slide, Emmett, we're going to look at like what are the trends that we're seeing among those sites that are growing at rates that are much faster than that 0.6 industry average. I looked at it and I kind of saw that there were 4, maybe 5 different key trends that I was seeing among the sites that were the fastest growing, that were still posting significant revenue. And one of the first ones that I saw was customization. Like, you know, there's a lot of ingredient based marketing and productization out in the marketplace. But there are a number of sites now that are allowing consumers to concoct their own custom formulas, picking ingredients and formulations and putting them together. And those sites, which you see here on the left-hand side of your screen, are among those that are driving the greatest year-over-year growth, with Lotion Crafters up 120%, Function of Beauty up 102%. We're also seeing some of the legacy brands doing really well, you know, moving into rather, pushing more sales through their own D2C channels. So Clinique.com, Avon.com, Olay.com posting really strong growth in Q3. Hair concerns, I grouped this together because it's really a combination of sites that deal with kind of serums and lotions and treatments that you can put onto your scalp to help increase hair growth or provide thicker hair, but also supplemented by hair pieces and wigs and things like that. Those sites like Kalei and Hollywood Hair Bar are showing really strong growth. Vegamore, which is showing only 15% growth, is one of the largest beauty sites that we're tracking right now. So it's normal for it to post a smaller amount of growth. But that's really focused on kind of a formulaic approach to increasing hair thickness. We're also seeing on Amazon, Cosrx is doing extremely well. It's another one of those brands that kind of keeping an eye on, and also this entire category, which we'll expect to kind of continue to drive beauty growth moving forward. And then I just wanted to mention, you know, we have some of these celebrity-backed brands, which you hear like a mix of like what's going on with them. Unlike the legacy brands, which are kind of moving from retailers to D2C, celebrity-backed brands had moved from D2C into a more retailer focused approach. But we're still seeing some nice growth in Rare Beauty, which is backed by Selena Gomez, and Meaningful Beauty by Cindy Crawford, and Kylie Cosmetics from Kylie Jenner. Those are all still showing some really nice growth in the quarter. In the next category that we're going to look at is apparel. So we saw that the apparel grew about 2.8% overall in the quarter, generating about $13 billion in sales. Again, we saw sessions were down, but conversion rate and average order value were up, kind of helping boost the apparel category overall. So the declining sessions numbers are still going to be a concern for everyone, because we're seeing that across the board. What companies need to do is make sure that they're kind of focusing on getting traffic from new sources, but also making sure that traffic that they do have continues to convert at higher rates, and that they convert at a higher average order value. The next slide kind of digs into where we're seeing faster than average growth in the apparel category, separated by some of the key subcategories, because apparel is so big. The footwear category, we're seeing brands like Athletic Propulsion Lab and Altra doing really well, posting almost double, triple growth year over year. Fry & Company, I think, is an interesting one. They primarily deal with like not athletic shoes, but like Western inspired footwear. And that's a trend that we're seeing across multiple categories. That kind of rustic Western inspired style and design is something that you're going to see among some of the faster growers across a number of sites. Now, luxury is tracked in its own category, but we do have some of the higher end retailers here: Billy Reid, Love Shack Fancy, Demilier, London. Those posted really strong growth. And it's interesting, Billy Reid and London's Shack Fancy both had some really interesting collaborations recently. Love Shack Fancy, for instance, did an exclusive mug with Stanley. And so that created big sellouts on Stanley. So really interesting to see what some of these higher end brands are doing, not just on their own, but in collaborations with other brands. Loungewear is another category, that we've seen doing really strongly in the past. Loungewear, athleisure wear, but Evergy and Honey Love being some of the fastest growing brands in that category. I'll move on to kind of the home and garden one. As I mentioned before, It is a category that still is technically in negative territory, but we are seeing some movement towards the center, and hopefully with these interest rates declining, hopefully moving into positive territory in the next quarter or so. But it was down 3.6% in Q3. It's also showing declining sessions like everybody else, declining conversion rates, but average order value is up about 11% year over year. And so we'll look at some of the categories that are subcategories rather, that are posting some stronger growth in home and garden, starting with furniture. And if you want to move to the next slide, one of the trends that we're seeing is we see like cozy and Lovesac. These kind of, we went from bed in a box to, let's say, like a couch in a box, or couch in a crate or something like that, is a category that's growing pretty well across multiple sites in that category. We're also seeing namesake and urban natural, kind of these kind of whole kind of modern but minimalist inspired brand styles. Outdoor living, in the past, we'd seen like these outdoor like heaters and fire pits doing a lot of the heavy lifting in terms of growing at the home and garden category outside. But this last quarter, we really saw the explosion of like Blackstone and some of the elevated grilling and outdoor cooking companies. Whereas that's not just Blackstone specific, but also companies that support or specialize in that category. When it comes to DIY, that's where we're really going to start to maybe see some growth with interest rates coming down. We're seeing some of the D2C DIY, which are like furnishings, faucets, knobs, floorings, things like that you buy directly from the manufacturer. We're also seeing some of the tool sites now. Traditional hardware is still not coming around, but these are some of the early indicators that DIY is starting to come back. And then when I mentioned bed in a box before, we saw kind of that category has moved beyond just the mattress to a larger bedroom lifestyle, or a home solution. And we're seeing brands like Thuma and Boll & Branch and Plank kind of leading the way in terms of growth in that subcategory within home and garden. And then I'll finish with electronics, but I'll go a little bit deeper here because I think there's some really interesting trends to pay attention to. So as I mentioned, electronics was the fastest growing category in Q3. It grew at 11%. That's after years of kind of suppressed demand after like the COVID bonanza spending, where everyone was going online and buying everything that they needed to work from home. But electronics is back. Apple had a really good quarter. That's, we're not keeping that a secret, drove a large part of that 11% growth. But we're also still seeing, like other categories, a decline in sessions. So it's not, the growth is coming from consumers spending more and converting at higher rates. But if we go into like what is actually driving that, and I think I'm not going to look at like the big players, but I want to look at some of the smaller or niche categories. And one that kind of fascinates me the most is this kind of like portable power, kind of green power, especially often paired with solar, EcoFlow, Jackery, battery backup power, all growing at really strong rates. And we'll dig into that a little bit more. But it's important to note that like these are companies that had been doing really well before. And now we've had some of these hurricanes and other natural disasters that have extended their growth even more in recent months. And we expect probably Q4 with Milton arriving to be another very strong quarter for this type of the sub industry within electronics. Headphones also did really well. We saw a number of new kind of iterations of headphones coming out in the last quarter, not to mention Apple's kind of updated theirs, but we've also seen some really kind of niche high-end headphones coming out. And that reaches to the actual manufacturers themselves, but as well as companies like headphones.com that specialize in high-end specialty headphones across multiple manufacturers. The next one is hi-fi audio. I think I want to take this and look at like the people who bought like the turntables and things have now kind of moved on and invested in higher end like amplifiers and other high-end hi-fi equipment for their home. And then I think this is also really interesting. The parts industry is getting really is seeing a really big boost in sales. Multiple sites among the fast growers specialized in parts, and these are just a few of those that we saw growing at really strong rates in Q3. And then I'll just finish up by looking at some of the stuff that I mentioned in terms of the portable power stuff. I've been looking at this kind of every time there's a sale or every time there's a natural disaster. There's very clear indications that these are driving the category overall. You can see here the daily sales for Jackery in blue and EcoFlow in purple here. You can see that, you know, Amazon Prime Day was a core driver of their success, especially in the month of July when both of them reached really strong record highs. But then if you see further there on the right, you see heading into like the end of September, the end of the quarter, we saw Hurricane Helene come in and sales jumped back up at just as they were kind of leveling back off to pre-Prime Day levels. And then we had kind of like the perfect storm where we had Hurricane Milton approaching Florida, as well as Prime Big Deals days happening at the same time. And those two combined helped Jackery sales move to their highest levels that we have seen in well over a year. And so moving into moving to like the holiday season, Black Friday, Cyber Monday, expect these to be really big sellers. And the next slide shows that, you know, this is also a category that has really high-end products, which helps move that overall average order value for the electronics category up. These are the top 5 best sellers on Jackery.com. You can see all of them are priced above some of them significantly above $2,000. But you can regularly get coupon codes and other discounts through Prime Days and whatnot that will bring hundreds or even thousands of dollars off of those prices. So we're going to see how they can move forward without being so reliant on mega discounts. But we think that this is a category or subcategory within electronics to clearly keep an eye on. So that's kind of wraps up kind of the overall e-commerce trends. If you're interested in digging into any more of these, feel free to reach out through Emmett or LinkedIn. I'm happy to go into more details. Thanks.
Thank you, John. Well done for squeezing so much into 10 minutes. Thank you as ever for your data insights. So let's hand over to Austin, please, who'll take us through the public market comparables. Over to you, Austin.
Thanks, Emmett. I'm coming to you guys from an airport today, so I apologize in advance if there's any background noise. Super quick primer on DrivePoint and what we do. We assist consumer companies, so we exclusively work with consumer brands on FP&A and financial forecasting via our software platform. Essentially, what we've done is package up what you might get from an FP&A analyst, turned it into software, and made that available to the lower middle and middle market at about 1/6 the cost of hiring a full-time analyst. So if you're a brand operator and you're struggling with finance or frustrated with your fractional CFO or sick of wrangling your model manually, please give us a call. As part of that, we're always asked to help our companies and our founders understand what their companies might be worth. And obviously, public market comps are a huge part of that. So several years ago, we started tracking an index or a basket of publicly traded companies that best represent what we look at as sort of the direct-to-consumer world. You can see some of the logos here. And we track valuation as a couple of metrics along with margin and growth and several other different factors. So you can flip to the next slide for kind of the most recent data. So at a glance, these are the key metrics that we sort of look at, obviously looking at revenues, looking at growth, percentage of direct-to-consumer revenue, gross margin, EBITDA margin, and then 2 different valuation metrics, one EV to sales and the other EBITDA. Obviously, a number of these companies do not have positive EBITDA, and so that multiple is not always so useful, but probably makes more sense for trading. And across the board, we tend to focus on the median numbers here. So the second row from the bottom, you can see the weighted average, the market cap weighted average there at the bottom. All of this data is published on our website at drivepoint.io/D2C benchmarks, or you can find us by Googling D2C benchmarks. And we release this data and as part of a weekly newsletter as well. So if you're interested, please go over there and subscribe. You can flip to the next slide so we can see the trends. As Emmett mentioned, we finally have a bit of good news. So you can see for a long time, basically since we started tracking the index, we were operating in pre-COVID universe, somewhere up around, the 15x EBITDA multiples, 2.5 to 3 times sales was the median. And then as we got into 21 and 22, we sort of started to see those numbers normalize. And we've been trending in sort of this, high 7s, low 8s on an EBITDA basis for quite some time. and then seeing the EV to sales multiple on a median basis trailing right around 1x. And so the latest reading, we've had, I think, 3 or 4 weeks in a row where we've been holding a 9 handle on the EV to EBIT mark, which is great. So starting to trend back toward that 9 or 10x. And I think in many cases, starting to see some reflation of multiples over the last 3 months. I think we've seen an uptick in the markets generally, but consumer and consumer goods have been a primary beneficiary of that. So, which almost never happens. Both consumer discretionary and consumer staples outperformed technology and a lot of the broader market indexes. So consumer staples over the last 3 months up almost 8%. Consumer discretionary as a sector up just about 3.75%. So starting to see some real returns and some capital flows into these sectors, which is great for the overall index. If you flip to the next slide, Emmett, just to go into some detail, this chart hasn't changed too much in terms of the market cap. These are sorted by market cap here. I think we've seen winners and losers over the last couple of months for sure, but starting to see some names do particularly well and start to perform. And reading through the earnings reports and looking at the numbers, a lot of these brands are coming out of a period of 18 to 24 months where they've really been focused on squeezing margins and efficiency out of the business and are starting to see some gains from that. So there's some brands that have been around for a while. Sleep Number being the top performer over the last couple of months. That stock is up almost 60% over the last 3 months. And that's primarily due to some increase in growth, but also a ton of increase in efficiencies and initiatives that were put in place starting in 2020 and 2021 and 22, starting to come online and really show themselves in terms of the earnings and the gross margin profile of these businesses. If you read through their earnings reports, especially of the high performers, almost all of them have seen improvements in gross margin over the last couple of years and continue to show, 100, 150, 250%, basis point improvements in gross margins. So a lot of efficiency gains inside of these companies, and they're starting to reemerge into this new market landscape with stronger fundamentals. Companies like Laird Superfoods, relatively small market cap, that emerged a couple of years ago and it sort of saw a massive drop in valuation, starting to actually show signs of being a sustainable, profitable business, up almost 30%. Olaplex, a beauty company that itself had a little bit of a turnaround, was sort of a high flyer, had to come back to earth, reset, get the margins right, up 20%. So some really interesting stories starting to reemerge. Honest Company's another one in that same bucket. Obviously a high-flying IPO, celebrity-backed, had struggled for a couple of years, now starting to see some what looks like sustained growth, refocus on fundamentals and getting back. So some really interesting things happening. Just a couple of other last things to point out. The median on a valuation basis has been, in that 9 handle, but there's some really interesting outliers here. If you look at a company like Warby Parker, so Warby Parker, another one that has recently come out and obviously had some struggles after the IPO, starting to build back in a more fundamental way, now trading at almost 80x EBIT. Hims, another health tech company that we've spotlighted before on this webinar, trading at well over 100 EBIT. I point those two out, and that we're seeing in the private markets as well a huge swing toward health tech. So Emmett, congrats on launching the M&A into that specific vertical, but lots of interest there and lots of private market companies that we're seeing. I think we've signed 7 or 8 new clients in that sector, all of whom are flying really, really high right now. There seems to be intense consumer demand for telehealth solutions and things that you used to have to go to the doctor's office for that you just don't anymore. So huge multiples there. And then, interesting to see some other brands, trading on high margins. Oddity, ELF Beauty in the beauty sector, all trading well above 15x on an EBIT basis. So, my takeaway for the brands out there is definitely some reflation in the markets, a little bit of a swing in terms of capital flows back to consumer, which is great to see it at the macro scale. And I think that will trickle down into the private equity landscape and into the venture landscape as well. And then certainly an opportunity to stretch margins and get a little bit more credit for growth, even if you're not all the way at that sort of 50 million and profitable mark. We're starting to see investors both in the private equity and growth stages be a little bit more lenient, be a little bit more forward looking, and starting to give credit for some things that may be positives in your business, even if they haven't shown up in the P&L. So overall, definitely a positive update. Seems like there's a little bit of a tailwind coming back to the market, which is great to see. And most operators that we're talking to are seeing a strong outlook for Q4 as well. So tone has shifted in a positive direction.
Great. Thank you, Austin, for that positive update. You've been doing this for many quarters, and that's the most positive sentiment we've heard from you, which is great. Let's hope it continues. So let's jump across, please, to Ken, and we'll talk about some specific M&A that he's done whilst in the seat at OpenStore.
Yeah,
Ken,
thanks. If you could just go to the next slide. So I joined OpenStore in April. And since that time, we've done a restructuring and a strategic review of our M&A strategy. But I can go into how we've pivoted. I think we're one of the aggregators that have yet to be forced merged, primarily because we financed the business with equity versus debt, which in hindsight was a good decision. Live to fight another day. To date, so we've acquired 4 brands. We have another term sheet out today that we expect to sign and hopefully close by year end. And like I said, our strategy shift is really what we found is that and I'm sure a lot of you on the call can attest to it if you're in market, that there's a gap right now, kind of in terms of angel seed, early VC capital in the D2C space. So historically, OpenStore was really buying anything. It was an inbound led process, automated M&A process, close in a few weeks, automated offers built on data science modeling. And what we have seen is there are really great brands that are out there that are early in their life cycle, and the founders are either just running into a capital ceiling or an operational capability ceiling, and they're looking for someone to partner with or take over their business and take it to the next level. So we've really focused in kind of what Emmett has as the micro market now. So we're looking at businesses that are doing as low as 250K of GMV, up to probably like 2 million or so. And what we're focused on is really finding the brands that we think have breakout potential. So if you go to the next slide, Emmett. And this is really, again, it was born out of one business that we acquired by the name of Jack Archer. It's a men's apparel brand. We've decided to really double down there and build out kind of a SWAT team, so to speak, to really grow that brand. It's had great success to date. We bought it 2 years ago. It was doing 400K in revenue. It's going to eclipse 20 million this year in revenue, profitable revenue. And so what we're focused on is finding the businesses that we think can get to that 5 to 20x stage, and obviously the law of small numbers helps that. But more so playing a little bit more of a venture game, but also focused on specific categories and customer avatars that allow for what we think is captive demand generation. Because one of the things that we really focus on is first order unit economics. And a lot of the brands that we're seeing that don't have high repurchase rates are negative. So the question is, do you have to develop NPD? Or how are you going to drive average order value up and lifetime value of your customers up if you don't have those positive unit economics? So you can go to the next slide. And this is really, I know people were asking some questions around in the chat and the Q&A that I tried to answer, but kind of what are we looking at as a buyer of D2C brands? So we're looking at growth drivers and risks, financials, business dynamics, market dynamics, operations is a big, as the buyer, you have capabilities. Does the business that you're looking to acquire require your capabilities or new capabilities? And oftentimes, channel diversification could be, sometimes I label that as diversification because, contribution margins, working capital cycles can be dramatically different across channels. And revenue is great, but, you can't spend revenue. or reinvest it. You need profits and cash flow. And so because of that, we focus on really doing a lot of diligence of, looking at a pro forma year one, year two. Historically, kind of through the, Amazon aggregator peak, everything was being valued at kind of trailing 12 months EBITDA, SDE. At Thrasio, when I was at Thrasio requiring kind of the last leg, we really started to lean into D2C brands. I think our last 20 acquisitions were primarily D2C brands because, the valuation, discrepancy that previously existed between Amazon and D2C basically closed dramatically. And so we kind of believe that D2C brands are more highly valued than just Amazon FBA brands. So we kind of made that pitch and switch. And what we're looking at here is the same thing. So we're not necessarily the deals are still valued on a trailing 12 months because that's kind of industry standard. But for our underwriting, we're really looking at, can we 3 to 5x this business over the next 12 to 18 months and really drilling down to what are the levers there. And because we're playing in the micro cap, like law of small numbers, some SDE or, some shipping charges or whatever can drive an extra turn of a multiple. So we're more thinking about it like deploying capital and saying, all right, do we think, we're going to generate a significant return on outlaying $400,000 of capital for this business versus, just a trailing 12 months multiple. One of the interesting things that attracted me to Open Store was because of the historical driving inbound flow in this automated process. They have data on over kind of 3,000 Shopify stores, like real first party data. And it's been a tech-led company from the beginning. And so we've built a really great data science evaluation model that looks at GMV estimates from other third party that we can kind of create really good confidence intervals around. We can benchmark on a lot of different P&L metrics up all the way down to contribution profit, and get a really good read on advertising trends and things of that nature. So we think we're in a good position. We're going to be strategic and measured on our M&A, and we think there's a lot of good conversations out there in the market that are happening. It's never been easier to start a D2C brand, but I think it's also never been harder to create breakout success because of rising CACs and the lower barrier to entry. I think that might be it for mine. Emmett,
Great.
Is there another? Do I have another slide on there?
You do? Yep.
Oh, okay. Yeah. And this is just more kind of, what we look for. We do initial screen, then we kind of have a fundamental review, and then really we dig into this breakout assessment. And we have a media mix model that we've built out based on our previous successes, and intelligence in the marketplace. And we think it's a really proprietary step in our process for M&A. And if anybody has any questions just on, multiples, what buyers look for, I know there's some questions around channel mix and how that plays in and things like that. Feel free to message me. I'm always happy to talk about this stuff.
Great. Thank you, Ken, as always. And feel free to keep the questions coming via the Q&A tab, and Ken will try and answer them live while we're on the call. Great. So we have 3 more sections to go through. We're going to have to keep them very punchy. Over to my colleague, Paul, to talk about brand metrics.
Thank you, Emmett. You can hear me, yes?
We can.
Great. I'll keep this short and sweet so that we get some time back. I know folks want to discuss the valuation trends at the end. So to summarize, there's a lot of questions going in via the Q&A. As some folks on this session may or may not know, obviously, how most brands are valued in the lower middle market section and indeed the mid-market section are of a multiple of EBITDA or SDE. Brand metrics encompasses all of your financial performance metrics and your e-commerce operational metrics into one. You'll see I have 4 sections outlined here. And to summarize, you obviously have financial metrics that contribute to the EBITDA base figure. And then the latter, be it a customer health metric, brand strength metrics, and data-driven forecast, lends itself more to the multiple that you would receive. Obviously, a strong performance in the underlying operational metrics that are driving that financial performance will attract a higher multiple from acquirers, and a lower vice versa will attract either a non-deal or a lower multiple received. Emmett, you can skip right to the valuation audit slide. There's a lot in this. Obviously, folks on the webinar will receive the deck following this. If you have any questions about the underlying key drivers of valuations from brand metric side, please reach out to me directly via the website, our Fortia website. I just want to update everyone that we obviously run exit processes, as Emmett said, for clients. We also work with clients on a twofold basis. Those that want to exit over 1 to 3 year period, but want to get exit ready, we offer bespoke programs to work with those clients today and help them achieve higher valuation over time. But we also offer clients an indicative brand valuation audit, which is a one-off audit product. Typically takes about 6 weeks to run. And what it provides is an indicative current valuation that your brand would receive should it engage in an exit process. More importantly, what the key gainers and drainers to that valuation are, both from a financial performance perspective and operational performance perspective, and then what a future valuation looks like should you choose to execute on some of those deliverables. If you have any interest in this service or want to find out more, please reach out to inquiries at the Fortia Group or Emmett or myself directly. Emmett, back to you.
Thank you, Paul. Great. 2 more sections, 1 deal dynamics, and then 3 valuation ranges. So I'll hand over to Stephanie, please take us through her thoughts on deal dynamics.
Thanks, Emmett. I'll bust through it quickly because I'm conscious of time. Obviously, there's like the broader M&A market, geopolitical influences, but these things that I'm going to discuss here today are generally going to be sort of in a company's control, right? So the founders and management teams should have these factors in mind as they think about going to market for a fundraiser sale. This is a sort of a short summary, and I'll kind of go into some specifics. The first one I'm going to talk about is shareholder dynamics. And a big factor here is sort of motivation and mindset, right? It's natural that people want to maximize the value, but in reality, if you've got unrealistic expectations, it can sort of derail a deal. Buyers are usually pretty sophisticated, and I realize that markets can be frothy, but generally speaking, buyers are not going to be sort of irrational. So for example, right, the appetite for consumer deals might have changed over the past couple of years. I'm based here in LA, where we've seen structural shifts in the production industry, for example. And so, if sellers don't acknowledge these shifts, you might just not have a successful deal. So that's where professional advisors can be very helpful. They help advise, owners arrive at a valuation that's justifiable, defensible, make sure everyone's, grounded and so on, especially in markets where valuations might have fluctuated. Another key point is pressure to exit. Ken sort of alluded to this a little bit. If shareholders are in a tight spot, they might have to accept a lower valuation. For founder-led businesses, that might be something personal, right? Like an illness or a financial squeeze or disagreements among partners. For funds, it might be more strategic, right? So, an investment sitting in an old fund that they need to wind down. They've shifted away from a certain sector, and so they want to exit things that are non-core. Then, you have distressed sales, which generally lead to depressed valuations, and that can create great buying opportunities as long as people go in pretty clear-eyed. One issue for sellers with distressed sales is that timing is sort of working against you. And unfortunately, I think shareholders and management teams often wait too long to address underlying issues, and then you're under more pressure to kind of get things done quickly. And buyers will just pick up on that urgency, especially if there's sort of looming liquidity issues. And that's where you'll see kind of lower multiples and discounted valuations. So be aware of that. Moving on to buyer dynamics, I make a distinction between financial and strategic buyers. Strategics like large corporations, they might be able to move more quickly on kind of a diligence front because they might understand the market more, but can move slowly just because of layers of decision makers. Whereas financial buyers are typically going to move faster and maybe have more flexibility on structure. I think one of the keys here is that strategic acquirers, are usually able to bid higher because of synergies with their existing business. That might be through cost savings or revenue opportunities. So if, acquiring your business gives them access to new customers or eliminates redundant operations, that value can kind of get factored into their offer. Timing matters here also. You want to understand where acquirers are in their capital cycle. If a private equity shop or VC has just raised capital or preparing to do so, they might be more aggressive and offer higher valuations because they want to deploy capital. Conversely, right, if people are on at the end of an investment cycle, they might be a bit more cautious about what they're going to pursue. Buyers with a strong track record will sort of inspire confidence, right? So sellers may accept slightly lower bids from experienced buyers if they know there's certainty, or they might prefer to work with a strategic that, sort of aligns with their, vision of the company. I've seen, for example, like a high-end accessories brand kind of accept a slightly lower valuation because they felt that, the strategic was going to steer the brand in the right direction. Finally, like if you're talking to sort of family offices, it's important to understand their source of wealth. So a lot of family offices rely on income from industries like real estate, energy, or commodities, right? Something that may be not related to your business at all, right? But those kind of underlying factors, affect their ability to invest and their interest, right? Moving on to the next page, right? Having a good advisor can really make all the difference. They help align the process with best practices. They reduce risks, keep timing on track, all of which will kind of maximize purchase price and net proceeds. And importantly, they kind of free up your time to run the business, which is critical. The number and type of advisors that you'll need really depends on the size of the deal, the market, and the complexity. If it's a smaller company, a solid attorney and someone on the tax and accounting side might be enough, especially if your management team is experienced. I have seen a company I know, go out to investors and say, here's the terms that we'll accept, are you interested? That works if the company is doing well, you've got good traction, a great customer base, and the team knows what they're doing. But more often than not, it's good to have someone helping you with it. And that could be an individual with deal experience or a firm like Fortia. They're going to expand your pool of acquirers. They're going to contact the right strategics, the right private equity shops, aggregators, whoever that might be. And that competitive tension is going to lead to higher valuations. They also know the market trends, right? Who's investing and where, and they'll help you negotiate and structure. Whoever you're working with, make sure they really understand your company and what's important to you. And that way, there's not going to be a bunch of time wasted because they're focused on things that you really, might not necessarily care about. And they keep everything moving. And I'll sort of talk about timing a little bit more on the next page. So you might have heard the saying that sort of time kills all deals, and that is true in M&A. It's important to keep momentum going during the process. It does take time, and as a seller, you need to do everything to kind of keep things on track. Buyers will help, align timelines. I mean, advisors will help, align the timelines between buyers, which can be tricky. Like I said, conglomerates can take longer than financial buyers. It's also important, to not go out until you're ready, right? Have all your documents prepared, work through structuring issues ahead of time. And that might be related to shareholders, or there might be subsidiary issues that you need to deal with. I've been on the acquirer side of deals where they fell apart because shareholder disagreements kind of came to light during the process. And that only, it sort of pushes the timeline, but it also can lead buyers just to be like, think, is this worth it, right? Timing the market is also important. So try to avoid launching, for example, at the beginning of summer, or, right before Chinese New Year, if you're targeting buyers in that region. For larger companies, vendor due diligence might be worth considering. That's kind of a pre-sale process where sellers engage outside advisors. It kind of it helps you identify risks up front. It gives the buyers more confidence, reduces price adjustments, which can lead to higher valuation. And finally, like, pick your battles. Like, you don't need to negotiate every single item. Know what's important to you and focus on those things. And because just trying to win every point can kind of slow things down. Lastly, I'm going to talk about, I think it's the last one, certainty of close. Generally speaking, buyers are going to value deals with less risk. So if you've got a clear timeline with limited contingencies, it's like fewer price adjustments. For example, if you've got minimal regulatory or legal risks, you're going to have a much higher certainty of close. Availability of financing can also play a key role here. Buyers with secured financing, they can bid higher because they know they're going to be able to close. And if buyers need to raise financing, it sort of, it just leads to uncertainty. I've been on the seller side of deals where we didn't engage with buyers, until because they didn't have financing clearly lined up. It was like, maybe it was a fundless sponsor and they were interested, but it's just really tricky it's just like another layer that they have to go through and a risk that sometimes isn't worth taking. For larger deals, we've seen staple financing come back into play a little bit. And that is financing that's pre-arranged by the seller and it's attached to the offering, and that kind of simplifies the process and decreases risk. So in short, sort of the fewer obstacles, the more attractive the deal becomes. So just to sort of wrap up, it's often a lengthy process. So take the time to prepare, have your documents ready, call Emmett, and figure out what's going to be important to you and be aware of the broader environment, and taking those steps are going to sort of help you achieve the outcome that you're looking for.
Great. Thank you, Stephanie.
Yep.
So let's jump from LA over here to Europe, and I will canter through the last section. So when we look back to the highs, that from our perspective was December 2021. The speakers today, we've covered 6 key factors that are the key inputs in our view into valuation. Global M&A activity, John covered e-commerce trends, Austin covered point 3, Ken covered point 4, Paul covered brand metrics, and Stephanie just covered point 6. Back in December 2021, literally these guys, the scoring for each of those was 10 out of 10. So it was the perfect storm. We do not think we'll be back to those levels again in the e-commerce world. That was a sort of a COVID-orientated environment. At our last quarterly webinar, July 2024, hopefully in the rear view mirror now, we are calling that the low. Out of total points of 60, we scored 19. So global M&A activity was, a multi-year low. E-commerce trends were tough. Public market comps were a lot lower than what Austin showed earlier. E-commerce M&A activity was tough. Brand metrics were hard and deal dynamics were poor. And that led to the valuation multiples on the right for FBA-led brands. Most profitable and growing businesses were trading between 2 and 3.5. On the DTC-led brands front, it was typically sort of 2.5 to sort of 6 with some outliers. So that was hopefully the low. More positive today, we're calling October 2024 brighter outlook. So the Fed reduction, all the points that we've seen, talked about on this webinar today, what does that mean for the Fortia Group scoring? So we've increased global M&A activity from 4 in July to 6 in October. That's based on the stats we've seen in terms of the deal counts and deal values. We've increased e-commerce trends just marginally. There's some positive news coming out of the data that Grips presented. We haven't got too excited. It's just gone from 3 to a 4. We have got excited about the public market comps. We've changed the scoring there from 3 all the way up to 6. It's by far the highest median EV/EBITDA we've seen this year. E-commerce M&A activity, unfortunately, we've had to keep that at 2. So there's lots of other positive murmurings. There's probably going to be a lag before we see that actually come through to e-commerce M&A, whether that's in Q4 this year or early into next year. Brand metrics we've increased slightly. As Grips data showed, most categories are seeing increasing revenue, although we remain cautious about the net margin trends. There's clearly increased costs and pressures on the P&L as you go down. And then finally, deal dynamics. We've increased this from 4 to 5 just to reflect the fact that credit is going to become cheaper, which helps acquirers, get access to cheaper money, and therefore hopefully be able to do more deals. And also, private equity are sitting on a lot of dry powder. Hopefully they will put that to work. So what does that mean for valuations today? All those factors taken into account. The way we see it now for growing and profitable FBA-led brands, the range is now 2 to 4, so slightly wider than we had in July. Diamonds, perfect brands trading, between 4 and 5. The highest we've ever seen for FBA is 7. We don't expect to get any near there. And anyone who thinks they can get that is not aligned with reality. On the DTC side, clearly DTC are higher valued businesses because they own their customers. So what we're saying now is we're seeing 3x to 9x is a fair range for growing and profitable brands. There's definitely exceptions to the upside if they're bigger businesses, if they're recurring revenue, if they're in favorable categories, etc., if they have super growth rates like some of the categories shown by John earlier. So that's where we're seeing it. We as a business, we don't deal in distressed brands or businesses. We only look to work with growing and profitable businesses or diamonds. And if you are in those categories and want to explore an exit in 25, 26, please do reach out. There's lots of things we can do to work with you. Do a valuation audit on where you are today. Think about presenting at our Acquirer Summit in January, or creating an exit ready plan, which could be 1 to 2 years long, to make sure that you ultimately get the best exit for your business. So thank you for listening. We squeezed a lot into today's webinar. If you have any questions, please email inquiries@thefortiagroup.com. And if you'd like to speak to any of the panelists today, come through us and we can connect you. Thank you and have a great day.